Hello and welcome to the lecture for part one of chapter 11. So today I'm going to talk about the overview of different forms of business. So I'm going to talk about sole proprietorships, partnerships, uh, LLCs, which are kind of in between partnerships and corporations, and then I'll talk about corporations in more detail. I'll talk about capital stock from an overview standpoint. And then in the second part of the lecture, I'll cover the other learning objectives, but the bulk of it is kind of in the first couple of learning objectives there. So I really enjoy talking to students about this particular subject because what I have found in past lectures on this topic is that I often tell students something that they didn't know before that's enlightening to them. Hopefully I always tell students things they don't know when I lecture, but in particular this one usually catches people off guard a little bit. And I'll call out those points as we come to them. So first, sole proprietorships. That's a company owned by a single individual that they're engaged in business as an individual person. So if you tune up people's cars or do oil changes in your garage on the weekend for extra money, you're a sole proprietor. I do some financial planning for business, some financial analysis work for companies that I do on an hourly rate. And when I perform those services, I'm acting as a sole proprietor. So one of the things about it, one of the good things about it is it's simple to form. So you don't need to do anything with an attorney or anything legal. You can apply for a business license or any other licenses that might be required. As an example, if you're going to be a manicurist or something like that, there might be licenses required, but there isn't a lot of legal hoops to jump through. By number of businesses, this is by far the most common in the country based on number of companies. It's important to recognize, and this is a key point, that there is no legal distinction between your business and you. So as an example, if you're doing work on people's cars in your garage on the weekend, and you fail to connect somebody's brake line and they leave and crash into a bunch of cars, you're personally legally liable for that error that your business made. So there's no difference between your business assets and your personal assets. Everything is on the table. That is probably the number one reason not to engage in business as a sole proprietor. So as I mentioned a few minutes ago, I do it when I do financial work for people, but I don't foresee there being much legal liability in that regard, so I'm not too worried about it. When I bought my company Big Toys, where when children fall off a playground, they can sue the company, I definitely would have never considered doing that as a sole proprietor. So I'll talk about that a little bit more when we talk about corporations. So the income of a sole proprietor is not taxable separately. It's taxed on the owner's tax return on their Schedule C. Sole proprietorships have a limited life, meaning when the owner dies, the business dies, and they have a limited ability to raise capital. Really, the only way to bring money into the business is for the owner to borrow money personally. So a financial statement for a sole proprietor, the big difference is really in the balance sheet. So the capital statement is another word for statement of stockholders' equity. In this case, there are no stockholders, so it's a sole proprietor. So it's just a capital statement. So there's one capital balance, and we add to it. We add net for investments. We add net income. We subtract withdrawals, and that's our ending capital balance. But on the balance sheet, you see under the equity section, rather than having common stock and retained earnings, we just have the owner's name and their capital account. That's their stake in the business at any given point. So pretty straightforward. The next category are partnerships, and that's an association of two or more people that are engaged in an effort to earn a profit. You can be in a partnership even if you haven't formally created a partnership. So if you and two of your other classmates decide to to make some t-shirts for some event at school that you want to try to sell, and you put your money in together and you buy blank t-shirts and you pay somebody else to do screen printing on them, and then you sell them and you split the money, you were in a partnership and you would be treated as a partnership from a legal perspective, even though you didn't file any paperwork or involve a lawyer. So partnerships are a little bit more complex to form, and the key thing here, and I could talk for an entire lecture just about this topic, the key thing is a partnership agreement. So the thing that's important there is that you sit down with your prospective partners and talk about all of the issues that need to be discussed. As an example, how are we going to split profits? Is it going to be evenly or through some other mechanism? What are the rules about adding new partners? If we want to add a fourth or a fifth or whatever the case is it a majority vote? Do we all have to agree? That sort of thing. How about breaking up when we decide that we don't want to be in a partnership, or maybe one of the people decides they don't want to be in the partnership? How do they get out of it? How do they get made whole? All of those kinds of things. So it's important, and what's critical is that you sit down and have the conversation about those things. Generally, legal problems and fights between partners arise when they haven't had those conversations and documented them. If you have the conversation, you agree on it, you document it, you all sign it, you're much less likely to have problems. So the item in red there is something to really point out. There is no limitation on legal liability for any of the partners. So it's called joint and several liability. So the entire partnership could be held liable for their debts. But as an example, if two of the partners are bankrupt, then the third partner could be held responsible personally, their personal assets, for all of the liabilities of the partnership. So any one individual partner can be held liable for the entire partnership. That's important to say. So that partner then could go after the other partners for their share, but if they're bankrupt, then you're not likely going to get much. So that's one of the biggest downfalls to a partnership as a legal form. Partnerships are not taxable unto themselves. They file an informational return and then issue a K-1 to each of the individual partners, and they include their portion of the partnership's income on their personal tax returns. They have a limited life. Technically, when one partner leaves or another partner joins, a new partnership has been formed and the old one has died. They have a limited ability to raise capital, again, because of that liability issue. People aren't wealthy people with a lot of assets aren't very interested in exposing their assets to that potential liability. All partnership property is co-owned from the minute it enters the partnership. So if you contribute a computer or a piece of machinery or something to a partnership, that's now partnership property. You can't just take it when you leave. Partnerships have mutual agency, so any partner individually can obligate the partnership for an agreement or a liability. And then the one positive thing is you can participate in the income of the partnership. So a partnership's financial statements are going to look a little bit different. It's primarily the balance sheet that's going to look different. The other two look the same. But you can see now under the balance sheet, under the equity section, we now will have a capital account for each of the owners. So we'll see what stake each of the owners has in the business. And of course, those are going to be influenced by what they've contributed, the portion of net income that they've has accrued to their capital account based on the agreement that they have, and how much money they've taken out of the company would reduce their capital account. Limited liability companies, I mentioned a minute ago, are kind of a hybrid between partnerships and corporations. They have an operating agreement versus a partnership agreement. The owners are called members versus partners. The biggest benefit here is that there is limited legal liability. So each of the members or owners, their legal liability is limited to their investment in the company. So if something really bad were to happen in the company, your products end up killing people or something horrible, you could lose your investment, but you're not going to lose your home and your personal retirement savings and things like that, like you could in a sole proprietorship or a partnership. They're also not taxable. They have an unlimited life. It's a little bit easier to raise capital for a limited liability company, or an LLC is what these are also called. The last category is corporations, the type of entities we've been talking about since the beginning of the class. When you measure U.S. business by revenue now, over 90% of the revenue in U.S. businesses is earned by corporations. All of the entities that I've worked for over my career up until the point where I began teaching have all been corporations. So that's all of you will quite likely work for a corporation. So a corporation is a separate legal entity. It can enter into contracts in its own name. It can buy and sell assets, incur liabilities in its own name, separate from the owners. A key thing about corporations is they can sell shares of stock. Those are shares of ownership called stock, and that's primarily where we're going to talk about the rest of this chapter here. So it is the stockholders, or shareholders is another term for stockholders. They own the corporation by owning the stock of the corporation. That's an important concept. So public corporations are two different categories. Public corporations have their stock listed on public exchanges like the NASDAQ or the New York Stock Exchange, those kinds of places. So companies like Apple and Microsoft and Tesla and big companies like that, Ford and GM, those are all public corporations, meaning any member of the public can buy shares of that stock and be owners. They're held to a very high standard in terms of their financial reporting, because people that are not sophisticated investors can make financial decisions to invest in them. So they have a very high level of responsibility to the investing public to be very transparent. You can compare that to a private corporation, and another word for that is closely held corporation. That's where it's owned by a small group of stockholders. When I owned Big Toys, my wife and I owned 100% of the shares. So there wasn't any other shareholders. You couldn't buy a share of the company if you wanted to. So it was a private company. Corporations are a taxable entity. So here's the big downside, is that there is double taxation. So if we have a company and it earns $100,000 in net income, and we pay 21% corporate tax. So we pay $21,000 to the federal government for the corporation's tax. Now we've got $79,000 left. We distribute that to the owners. Now the owners will pay tax on that $79,000 as dividend income personally. So the profits are taxed at two levels, and that's one downside to corporations. That's why it's in red there. The chain of command in a corporation starts with stockholders. They're the owners of the company. So they vote their shares, and there could be some more complexity in this, but it's generally one share equals one vote. So if you own a lot of shares, you have a lot of influence on how the company is run. If you only own one or two shares, you don't have much influence. So in large corporations, people will run to be on the board of directors. So it's a relatively small group of people that actually set the direction for the company. So shareholders will vote for directors that they believe are going to move the company in a direction that they think is advantageous for their investment. So it is the board of directors that makes the big level decisions about what line of business should we be in, should we acquire a competitor, should we expand to a new market. Those kinds of questions are dealt with at the board of directors level. All of the officers of the company, so the CEO, the chief executive officer, the chief financial officer, it could be the chief information officer or the chief marketing officer, could be different titles in different companies, but that top level of management is hired by the board of directors, and that's who they report to. So the board of directors can fire the CEO of the company, and indeed that happens from time to time. The officers of the company then select management and supervisors and frontline employees and so forth down the organizational chart. You can see from this little diagram here, though, it's fairly clear why decision makers in a company make decisions in the interest of the stockholders, at least in their long-term interest, because it is the stockholders ultimately that they report to. So in forming a corporation, that is done state by state. You don't have to form in the state in which you're located. I've worked for companies that were based here in Washington that chose Delaware because they have favorable corporate laws. That state will grant an article of incorporation, so proof that the corporation exists under the laws of that state. That's the first step, filing an application and receiving your articles of incorporation. And then the board will meet and develop a set of bylaws that say, this is how we're going to run the company. This is how many board members we'll have. These are how long their terms will be. This is how we'll decide when we change board members. These are the kind of decisions that are reserved for the board versus allowed for management, that sort of thing. So we've talked about this before. This should be review. So the stockholders' equity section of a corporate balance sheet is going to be comprised of two different categories. One is paid in capital. That's money that has come into the company in return for the initial issuance of shares of stock. So that's when the company issues the shares. The company receives capital for that. So that's as opposed to when individuals buy and sell shares between each other, the company isn't involved in that transaction, so it receives no money. If I buy a share of Tesla from one of you, Tesla doesn't get any of that money. It's between the two of us. Tesla only gets money when they initially sell or issue a share of stock. There's also retained earnings. Retained earnings, I've mentioned before, are all the cumulative earnings of the company that haven't been paid out in dividends yet. So the last slide here deals with shares of stock. So there are three different levels. The board of directors will authorize a company to issue a certain number of shares. They can go up to that level without having to come back and ask, but they can't go over that level. So as an example, the board may authorize the company to issue 1 million shares. So the company might issue 600,000 of those shares. So those have actually been physically issued and in return for money or assets that have been given to the company. There's a smaller number that might be outstanding, and the difference between issued and outstanding would be shares that the company has purchased back. Those are called treasury shares, and I'll talk about those more in the second lecture. So depending upon state law, shares will either have a par value or a stated value, or in some states that's not required. That's a very low level of money that the corporations, it's called legal capital. They're required to keep that within the company to protect the interest of creditors. So again, if there's a par value associated with the stock, it would indicate that. And we'll talk about that more in the second lecture for the chapter as well. So the last point here, the rights of the shareholders. So they have the right to vote on corporate matters. Again, one share equals one vote. They have a right to share in profits that they receive through dividends that the company pays out. And then they have a right to the share of assets if the company gets liquidated. So if a company chooses to close down for whatever reason, they'll turn their assets into cash, they'll pay off their liabilities, whatever is left over gets distributed to shareholders based on the number of shares they own. So that's the end of the lecture for the first part. The second part will probably be a little bit shorter, and I will post a couple practice videos for some of the exercises that are due for the first assignment for Chapter 11. Thanks for your attention.